All right, well, the markets may be losing a bit of steam today. So far this year, nothing's been able to derail the bulls. But could we see this momentum begin to slow as the Federal Reserve prepares to take away the punch bowl? Todd Schoenberger is Managing Director of Land Colt Trading. Welcome back to the show, Todd.
Thanks for having me.
All right, so this Fed meeting and the unprecedented press conference following the rate decision, what kind of impact do you think, or how will the markets read it, and do you think it'll be effective?
Absolutely will. It's going to be very influential on Wednesday. But first of all, with this Bernanke press conference, there's nothing good that could come out of this right now. You already have a rising stock market, so we already know that. We already know that the Fed is going to come out. They can't say anything about more easing. We know that. They're actually going to be talking about tightening, and they'll probably give some clues as to when that may take place. But this press conference is going to be a disaster. And if you are an equity investor, you probably want to go short right before he starts talking, because you know how live TV can be, and it's not going to be good for equities.
Well, you know what, Todd? I read your newsletter from Land Colt every morning, and it seems like there's a very popular theme, and it's the stock market continues to go up, yet, or I should say, in spite of all of these things around the world that should be pressuring it to the downside, and yet it isn't. Yep. Do you think this means that there's a cliff awaiting for us right around the corner where we're really going to have a significant pullback?
Well, you would think that, Chris, because this is a stock market right now that has no fear in it. I mean, with everything that's taking place right now, how can the S&P be trading north of 1,300? It doesn't make a lot of sense. However, you only can think that Fed accommodation is being a big part of that rally or taking place right now. So as we move forward, we can only expect that with quantitative easing 2 ending in June, that's going to put a lot of negative pressure on stocks. And then when you incorporate all of those other issues, the geopolitical concerns, obviously the Japan tragedy, and anything else that's out there that is negative, that cannot be good for equities down the road. So as we've been saying in this newsletter, we do feel that something may be happening with the Fed, but it probably won't happen again till third, maybe fourth quarter of this year.
And Todd, we're not even talking about energy prices. Everyone's abuzz about gas prices, retail prices in some parts of the country possibly hitting $6 a gallon. I mean, Could that be the breaking point for the markets, if not the economy as a whole?
Absolutely. Absolutely, Lori. I mean, when you start talking about higher gas prices, you have to think about the discretionary income that's going to be taken out of the economy. And what is actually substituting that right now is the Fed liquidity injection. So you think about all of the billions that have been thrown back into this economy. That is actually something that's helping boost, obviously, earnings on the bottom line for these stocks. And you've been seeing that. But more importantly, you don't need the consumer there right now. So when you eliminate the Fed, you have to wonder, where's the money going to come from? It's obviously being thrown into gas pumps or gas tanks right now in all these automobiles, so it's got to come from somewhere. We need lower gas prices. Unfortunately, though, I think we're going to see higher prices from here on out.
Todd, an article you wrote a couple of weeks ago talked about the low volumes on the floor of the New York Stock Exchange. We talk about it all the time, how anytime we have an update, it's met with a very light volume. And we're also talking a lot about Rothman and that trial today as it goes to the jury. You think there's a connection there, don't you?
Absolutely. I mean, when you start looking at even the bulge bracket firms that have already reported, one underlying tone is low volumes from your institutional clients, hedge fund clients. And you guys know how these Wall Street circles of influence work. People talk, and you go out to the bars or the restaurants, and you have the meetings, and people do communicate. And there is that fear within the hedge fund community that if Raj is thrown into, he's found guilty, and that very well could happen, then the feds could actually come out and say, look, we have evidence here that we can go after other hedge funds. What you're seeing right now is a low trading volume environment. You're not seeing it from the retail investor. You've actually seen retail volume increase, but from the institutional and hedge fund professional, volumes have decreased, and they're actually hiding or staying under the radar. So we have to see what's going to happen with this trial. But yes, there is a connection. If he's acquitted, look for volumes to increase and look for a lot more money to flow into the markets. It actually should be a good sign for the markets.
All right, we'll see what happens. Todd Schoenberger, many thanks for your time and your analysis.